We've all seen the thumbnail, a guy in his 20s sitting on a beach in Bali, drinking from a coconut with a laptop perched on his knees. The promise is always the same: do the work once, get paid forever. It's the dream of the modern era, passive income. But if you actually look at the operational requirements of what these gurus are selling, whether it's Airbnb, rental properties, or e-commerce, the math tells a story they usually leave out. Most things sold as passive income are actually just small businesses in disguise. They aren't investments, they are second jobs with variable pay, no health insurance, and zero benefits. Today, I want to break down the return on time, or ROT, not just the return on investment. We're going to use a 20-year case study to see which path actually buys you freedom and which one just buys you another boss. Let's look at two investors, Wells and Carter. To keep it realistic, let's say they both have $60,000 in cash and earn $65,000 a year at their day jobs. They live in the same city, have the same bills, and the same goal: financial independence. Wells is a tangible guy. He wants something he can touch. He uses his $60,000 as a 20% down payment on a $300,000 rental property. It's a solid 3-bedroom home in a growing suburb. He locks in a 30-year mortgage at 7% interest, making his monthly principal and interest payment roughly $1,600. He finds a tenant who agrees to pay $2,100 a month. On paper, Wells is thrilled. He sees $500 a month in pure profit before he's even started. He feels like a mogul. He has a physical asset, a tenant, and a story to tell at the next family BBQ. Carter takes the same $60,000 and moves it into a total stock market index fund. No leverage, no tenants, no keys. He sets up an automatic monthly contribution of $400 and literally forgets the password to his brokerage account. His coworkers ask him what he's playing in the market. He says index funds, and they immediately lose interest. Carter has no story to tell. He just has a confirmation email and a number on a screen. Year 1 to 3, the landlord dream versus the boring screen. For the first 24 months, Wells is riding high. Rent checks hit his account on the first of every month like clockwork. He's claiming mortgage interest and depreciation on his taxes, which feels like cheating the system in the best way possible. He drives by the house on Sundays and thinks, "That's my retirement right there." Carter, meanwhile, is bored. He logs in once a quarter and sees his $60,000 grow to $66,000, then maybe $73,000. It doesn't feel like wealth. He doesn't have a key in his pocket or a tenant texting him. He's just watching a line graph slowly move up and down. But by year 3, the napkin math begins to bleed. Wells has collected $75,600 in gross rent. His mortgage payments totaled $57,600. That looks like $18,000 in profit, until the real world enters the chat. Property taxes, $3,600 per year. Insurance, $1,800 per year. In month 30, the HVAC system dies. That's $6,500. Then the tenant moves out, leaving a parting gift of stained carpets and a hole in the drywall. It takes Wells 6 weeks to clean paint and find a new tenant, costing him $3,150 in lost rent and materials. After 3 years of passive income, Wells's actual net cash flow is closer to $2,800 total. That averages out to about $77 a month, not the $500 he bragged about. Carter, who did nothing, is sitting on a portfolio worth nearly $96,000. The psychology of the return on time. This is where we need to define your most valuable asset, your time. If you spend 15 hours a week managing a property to make an extra $1,000 a month, you haven't built an investment. You've hired yourself for a low-wage job. If Wells spent 200 hours over 3 years dealing with screenings, repairs, and late-night calls for a total profit of $2,800, he earned $14 an hour. He could have made more money flipping burgers with significantly less liability. A lot of people tell Wells, "You should have made it an Airbnb. The nightly rate is way higher." But Airbnb isn't real estate, it's hospitality. You are running a boutique hotel where you are the concierge, the janitor, and the conflict resolution officer. Data from Host Resources suggests that self-managing a short-term rental takes 14 to 20 hours a week. That's half of a full-time job. You are trading your weekends so that a group of strangers can have fresh towels and a cute aesthetic. Then there's Carter's other coworker who started a dropshipping store. He tells Carter, "I don't even touch the product," but he's on a constant treadmill of content creation and ad management. If he stops making TikToks for 5 minutes, his traffic dies. He's essentially a freelance digital marketer for a factory in China, and when the shipping delays hit, he's the one answering the angry 3 a.m. emails. This isn't passive, it's high-stakes crisis management. The boring truth of capital allocation. The reason Carter's path is actually the smart play for most people is that it requires zero labor. Carter is practicing capital allocation. He is leveraging the labor of millions of employees at companies like Apple, Microsoft, and Amazon. When you buy a total market index fund, you are essentially saying, "I want to own the output of human ingenuity." You don't have to wake up early to stress about product launches or supply chains. The CEOs of the S&P 500 do that for you. Carter's maintenance time is maybe 2 hours a year to rebalance his portfolio. His return on time is mathematically infinite because his time input is effectively zero. The hardest part of Carter's journey isn't the work, it's the boredom. We are biologically wired to believe that effort equals reward. Our brains tell us that if we aren't doing something, we aren't winning. But in the world of compounding, doing something usually just means paying more in taxes and fees. The 10-year turning point. By year 10, the magic of both paths begins to show. Wells' $300,000 property has appreciated at roughly 3.5% a year and is now worth about $423,000. His mortgage balance has been paid down to roughly $205,000. His equity is sitting at $218,000. It looks impressive, but he's also dealt with 3 tenant turnovers, a new roof, and a legal battle with a neighbor over a fence. Carter's portfolio, with those $400 monthly contributions and a 10% average return, is now worth roughly $235,000. He hasn't touched a tool, hasn't taken a phone call, and hasn't lost a single night of sleep over a broken pipe. At the 10-year mark, Carter is actually ahead of Wells in net worth, and he's thousands of hours richer in time. The 20-year showdown. This is where the math gets brutal for the passive income gurus. After 20 years, Wells' house is worth roughly $600,000. The mortgage is nearly gone, and his equity is about $450,000. He has collected years of rent, but after accounting for 2 decades of property taxes, insurance, 3 major renovations, roof, kitchen, HVAC, and vacancies, his total profit from cash flow is roughly $90,000. His total net worth from this one decision is $540,000. Carter's original $60,000 plus $400 per month has compounded into approximately $680,000. Over $450,000 of that is pure growth, money he never worked for. Wells worked for 20 years to build a $540,000 asset. Carter waited 20 years to build a $680,000 asset. Carter has more money, and more importantly, he has all the thousands of hours he didn't spend being a landlord. The hidden risks we can't ignore. I'm not saying the stock market is a risk-free ride. It's not. Volatility is the price of admission. In 2008, the market dropped 37%. In 2020, it dropped 34% in a month. If Carter had $400,000 and watched it vanish to $260,000 in 3 weeks, he would feel sick to his stomach. Most people panic at that moment and sell, which is the only way to actually lose money in an index fund. Real estate has a different kind of risk, illiquidity. If Wells needs $50,000 for an emergency, he can't just sell the bathroom. He has to take out a loan or sell the whole house, which takes months and costs 6% in commissions. He is also concentrated. If a massive factory opens up next door and ruins the air quality, Wells' entire net worth takes a hit. Carter is diversified across thousands of companies. One bad neighborhood can't ruin him. The verdict. When does real estate win? If the math is so clearly in favor of index funds for the lazy investor, why does anyone do real estate? Because real estate wins in very specific professional scenarios. High-level tax magic. If you are a high-income earner, Depreciation and 1031 exchanges allow you to grow your wealth almost entirely tax-free, something Carter can't do outside of a 401k. House hacking. If Wells lived in one unit and rented out the others, he could effectively live for free while building equity. That is a massive multiplier that the stock market can't replicate. Active value add. If Wells bought a fixer-upper and used his own labor to increase the value by $100,000 in 6 months, he's not an investor, he's a skilled laborer. That can generate massive returns, but again, it's work. Conclusion: stop buying a boss. The real trap isn't real estate or stocks. The real trap is picking a path based on a YouTube headline or something your uncle said at Thanksgiving without ever running the numbers on your own life. If you have zero capital, you have to be Wells. You have to hustle, you have to take on a side job, and you have to use your time to build your first $50,000. But the goal should always be to move that money from the active bucket, where you work for money, to the passive bucket, where money works for you. Don't get stuck in the middle, the freedom trap, where you think you're an investor, but you're actually just a tired business owner with a second job you never really wanted. True freedom isn't just about having a high net worth, it's about having a high net worth and the time to actually enjoy it. Next time someone tells you they have a passive income stream, ask them, how many hours did you work for it this week? Because the only answer that leads to true freedom is none.